Hey guys, in this video, I'm going to talk about the 5 best dividend ETFs that have beaten the S&P 500 by as much as 260%. And not only did they beat the S&P 500 since their inception dates, but their dividend growth has been better than the S&P 500 as well. So if you're looking for the best dividend ETF to add to a growth-oriented portfolio, stick around because I think one of these ETFs might be just what you're looking for. So here's what you will learn in this video. First, these 5 ETFs have an annual total return that is between 1.1% to 3.8% higher than the S&P 500. But you also need to know the downside risk, so I'm going to be sharing their performance during the Great Recession as well as the COVID recession. And by the way, I've listed the ETFs in the description with the timestamps, so feel free to jump ahead to whatever ETF is the most interesting to you. Second thing is, one ETF has a 10-year dividend growth rate that is almost 4 times the S&P 500, which is just insane. And I'll show you exactly what's been going on with this ETF. Third, 2 of the ETFs grew twice as fast as the S&P 500 since the market bottomed out in March 2020. And the last takeaway here is the top performing ETF grew a $10,000 investment to $63,000, beating the S&P 500 by just over 260% over the course of 17 years. And this includes all dividends. So if you want to find out which ETF this is, be sure to stick around till the very end. Before getting started, we need to be clear what exactly we're referring to as a dividend ETF. And to be honest, there's no single definition of what a dividend ETF is or is not. And so there are basically 4 qualities that I screen for to identify the best dividend ETFs for a growth-oriented portfolio. So the first quality that I was looking for were ETFs in the equities category. So only stocks, no bonds, no commodities, no exotic ETFs like leveraged or cryptos or anything like that. The second quality I was looking for were ETFs that have a total return that's greater than the S&P 500 since their inception. And if you're not aware, the S&P 500 is widely considered the industry benchmark for equity performance, so we will likewise do the same here. The third quality I was looking for were ETFs that have a dividend yield of at least 1%, and that is lower than the 1.5% yield you can get today from some of the biggest S&P 500 tracking ETFs on the market. But I'll show you in a moment just how fast these ETFs could close that gap based on their dividend growth history. And lastly, I was looking for ETFs that didn't have an expense ratio that was greater than 0.5%. All right, so the very first ETF on the list is RYT, and this is the Invesco S&P 500 Equal Weight Technology ETF. It has assets under management of $2.4 billion with an expense ratio of 0.4%. It has an inception date of November 2006 with a yield currently of 1.25%, and it's holding 74 different companies. This ETF is investing in companies across the IT sector and both growth and value companies, and it's trying to track the S&P 500 Equal Weight Information Technology Index. And this index invests in equal amounts to all 74 companies. Now, typically low-cost index ETFs are tracking market cap weight indexes, meaning the biggest companies make up a bigger share of the assets. Like right now, if you own an S&P 500 index fund like VOO, you have a large stake in Amazon, Apple, Microsoft, Facebook, because those companies are essentially just the biggest companies in the market. But if any one of those companies were to suddenly lose their value, suddenly their stock prices drop, it's going to hurt. Whereas if you own these companies in equal share, along with another 70 others, you aren't as heavily exposed to any one company. And that's where this ETF comes in. And one of the benefits from equal weighting is that you get more exposure to the smaller companies that tend to grow faster. And right now, the small cap sector looks to be undervalued based on several market valuation measurements. From a dividend standpoint, here's the 1, 3, 5, and 10-year compound annual growth rates of the dividend for RYT and SPY. Now, SPY is the largest low-cost S&P 500 ETF on the market today. And just for simplicity, I'm going to be using it as a stand-in or proxy for the S&P 500 for the rest of this video. By each of these measures, RYT's dividend growth rate is on a whole different level compared to the S&P 500. Like 40% for 3 years, 79% for this past year alone. It's crazy. And these are the highest rates of any ETF on the list. And honestly, I don't think that these rates are sustainable, but I could be wrong. But assuming they are, and even though its yield is right now 0.25% lower than the S&P 500, if we do a simple back of the envelope projection of the dividend yield based on the 5-year rate, RYT's yield will exceed the S&P 500 yield in just 2 years. So the difference in the yield doesn't really mean much in light of how much the dividend is likely to grow. And you'll see that this is going to be true for all the ETFs. From an overall performance standpoint, RYT's return over 14 years since its inception has been much higher than the S&P 500. RYT had a CAGR of 13.4% compared to SPY at 9.6%, beating the benchmark by close to 4%, which is just insane. And the cumulative return over 14 years has been 498%, compared to SPY at 270%. From a downside risk perspective, we can look to the recession losses during the Great Recession and the COVID recession. So during the Great Recession, the S&P 500 fell 52.9% between its highest point on October 1st, 2007, and then it bottomed out on March 1st, 2009. And during that same time frame, RYT fell 55.4%, so a little bit steeper than the benchmark. Then during the COVID recession, the S&P 500 fell 33.4% between February 20th, 2020 to March 23rd, 2020, while the RYT dropped 33.2%. So not much difference between the two here. Then if we look at the rebound since the market bottomed between March 24th, 2020 to January 15th, 2021, RYT rose 62%, while SPY rose 56.4%. So overall, RYT had more upside over the 14 years of performance and had similar downside performance during the last 2 recessions. Now, I want to mention that this and every dividend ETF that I'm going to be talking about can be purchased commission-free, management fee-free on M1 Finance. And if you're not familiar with what M1 Finance is, it's a fintech company that offers, in my opinion, one of the best passive investing platforms for dividend investors. Right now, for a limited time, they are offering $30 free for new users who sign up and deposit $1,000 by January 2021. And they're offering a free 1-year trial membership of M1 Plus. M1 Plus is the premium membership program, and it offers additional perks not available to basic users. And it typically costs $125 per year, but it's available for free for new users. So if you're interested in getting in on these deals and trying out the platform, I have a link down in the description where you can sign up. So I'm personally using their platform for my dividend portfolio, and it's been a great experience so far. They make it really easy to automate everything, and their user interface is very seamless, and I can rest assured that my money is safe and insured. So definitely check it out if you're looking to start investing, and you can just get a nice bonus for a limited time. All right, the next ETF is the ticker symbol MOAT or MOAT. Fund is VanEck Vector's Morningstar Wide MOAT ETF with assets under management of $4.3 billion. Its expense ratio is 0.48%, which is actually the most expensive ETF on the list. It has an inception date of April 2012 with a yield currently of 1.39%, and it holds 50 companies, which happens to be the smallest number of holdings of the ETFs on the list. Now, this ETF invests in an index that tries to find companies at attractive prices with sustainable competitive advantages or a wide economic moat. As of the end of 2020, the ETF holds the biggest positions in John Wiley & Sons, Inc., which is a multinational publishing company focused on academic and instructional materials. And then Charles Schwab Corvetta, which is the biggest pure agricultural chemical and seed company that was spun off of Dow DuPont. US Bank, Wells Fargo, and Constellation Brands round out the top 6. And then if you look at the sector breakdown, healthcare, financials, and IT make up more than half the holdings. Looking at the dividend quality, here's the 1-year, 3, and 5-year dividend CAGR for MOAT compared to SPY. So the growth rate of MOAT's dividend has been incredible the last 3 years, with the exception of this past year. This chart here is showing the total annual dividend payout, and the dividend fell pretty hard from 2019 to 2020. But over the course of just a few years, the trend is clear that the dividend has been growing pretty aggressively. And then from a performance standpoint, MOAT has had a better performance record than the S&P 500 since its inception. So MOAT had a CAGR of 15.6% compared to SPY at 14.5%, which means it's beating the benchmark by an average 1.1% annually. And its cumulative return over its 11 years has been 253.2% compared to the SPY, which was at 225.8%. Now, MOAT was not around during the Great Recession, but if we look at its performance during the COVID recession, the drop was nearly identical to the S&P 500, off by just 0.2%. Then if we look at the rebound from the market bottom, MOAT has risen 57.3% compared to the S&P 500, which has risen 56.5%. All right, the next ETF is ticker symbol VXF, and this is the Vanguard Extended Market Index ETF with assets under management of $13 billion, which happens to be the biggest ETF on the list. Its expense ratio is 0.06%, and that makes this ETF the cheapest ETF on the list. It has an inception date of December 2001, and it yields 1.01% currently. It holds 3,339 companies, and what this ETF is tracking is the performance of the S&P 500 Completion Index, which follows mid and small cap companies in both the growth and value categories across virtually all the sectors in the economy. So it has the biggest exposure to the technology, healthcare, and financial sectors, but unlike some of the biggest S&P 500 ETFs, where the top 10 companies make up close to 25 to 30% of the assets, the top 10 companies in this ETF make up less than 8%. And this includes companies like Square, Zoom, Uber, Snap, Workday. I mean, these are just some of the smaller tech companies that have grown really aggressively. And I'm going to show you in a second, but it is just incredible how getting exposure to these mid and small cap companies can really boost your portfolio returns. But before we look at how it performs against the S&P 500, I want to quickly show you the dividend growth rates here. So over the past year, it has beaten the S&P 500 dividend growth by 6.4% annually, and over 10 years by more than 3%. So if you're looking for a high appreciation, high dividend growth, low cost, and getting exposure to companies that you might be missing in an S&P 500 ETF, I think this ETF is definitely worth considering. From an overall performance standpoint, VXF has grown 11% annually versus SPY at 8.5%, and the cumulative returns over close to 20 years has been 626.5% versus SPY at 368.9%, which comes out to a staggering 258% difference. From a recession standpoint, VXF dropped 55% during the Great Recession versus SPY at 52.9%, and then during the COVID recession almost 11 months ago, VXF dropped 41.6% versus SPY at 33.4%. So much more downside risk compared to the benchmark. However, if we look at the recovery since then, the ETF has risen 105.5% from the market bottom versus 56.5% for SPY. So it has recovered nearly twice as fast. The next ETF is a ticker symbol SPGP, and this is the Invesco S&P 500 GARP ETF. Now you may be wondering, what is GARP? It doesn't sound very attractive. Well, GARP stands for growth at a reasonable price, and it's an investing strategy where you look for companies that were somewhat undervalued but have good growth potential so that you avoid overpaying for that growth. It has assets under management of $318 million, which happens to be the smallest ETF on the list. Its expense ratio is 0.34%. With an inception date of June 2011, it currently yields 1.05%, and it holds 77 companies. So this ETF tracks the S&P 500 GARP index, which is made up of about 70-something companies in the S&P 500 that are identified as growth companies with strong fundamentals at a reasonable valuation. And so if we look at its holdings, companies that meet these qualities include Facebook, Cigna, SVB Financial Group, Adobe, Synchrony Financial, just to name a few. And then at a higher level, it has the most exposure to financials, information technology, and healthcare. Those three combined make up more than 60% of the ETF's assets. Looking at the dividend growth rates, the different CAGRs have been in the double digits across the board, and it's grown really aggressively, but if you look at the quarterly payouts themselves, it is very inconsistent. So it's something that you want to consider if a steady payout for income is really important to you. Now moving on to the performance, SPGP has grown 16.2% annually over 9 years, while SPY was at 14.3% over that same time period. The cumulative returns has been 322.2% for SPGP versus 258.8% for SPY. Then looking at the recession losses, SPGP was down 41.8% during the COVID recession, which was 8.4% lower than SPY, which is actually the steepest drop of any ETF on the list. And then since the market bottom, it has risen 80% over the last 10 months, compared to 56.5% for SPY. All right, the next ETF on the list is the ticker symbol VCR. And this is the Vanguard Consumer Discretionary ETF. And now I covered this ETF as a part of my video on the best Vanguard ETFs, which I will link down in the description if you want to check it out. And honestly, I was very pleasantly surprised that it also made a list in this video. And this is the only sector-specific ETF on the list. And it's not something I was necessarily excluding for as part of my criteria. And it just happens that the combination of performance, yield, and low cost makes this one of the best ETFs on the list. So it has assets under management of $4.7 billion. Its expense ratio is 0.1%. As an inception date of January 2004, it currently has a yield of 1.63% and it holds 300 companies. Now, this ETF tracks the performance of the MSCI US Investable Market Index Consumer Discretionary 2550, which is an index made up of stocks of large, mid-sized, and small companies within the consumer discretionary sector. And so this includes companies like Home Depot, McDonald's, Starbucks, Target, TJ. But one of the biggest drivers of VCR's outsized gains, which I'll share in a moment, is due to Amazon and more importantly, Tesla. These two make up more than 30% of total assets of the ETF as of end of 2020. From a dividend standpoint, here are the 1, 3, 5, and 10-year dividend CAGR comparisons. So over every time period, VCR grew its dividend by more than SPY with a staggering 14% annual growth rate over 10 years. And VCR had an unusually high dividend distribution as of the most recent payout date. And it made the CAGR calculation a little bit nonsensical, so I used the trailing 12-month as of the June payout as a proxy for the 2020 total dividend payout. From an overall performance standpoint, VCR had a CAGR of 12.5% compared to SPY at 9.6%. The cumulative returns over 17 years has been 632% compared to SPY at 371%. A crazy difference of 260.5%. From a recession performance standpoint, this ETF has been around since the Great Recession, and during that time, it dropped 56.2% compared to 52.9% for SPY. And similarly, during the COVID crisis, which I'm showing you here, VCR dropped more than SPY at 36.3% versus 33.4%. But then if we look at the rebound from the market bottom between March 24th to January 14, 2021, VCR rose 107.1%, while SPY rose 57.6%. Tesla is the main reason for VCR's spectacular outperformance. While Tesla makes up only 11% of VCR, it only makes up 1.7% of SPY. And considering Tesla had already gained something around 650% prior to being added to the S&P 500, it only makes sense that VCR's overexposure to Tesla throughout the run-up prior to its inclusion gave it a huge boost compared to SPY. If you found this video valuable, be sure to hit that like button down below and don't forget to subscribe and hit that notification bell so you don't miss out on any future videos. Thanks for watching and I'll see you guys next time.